We want to welcome everyone to our Thursday Greenleaf Connect event in partnership with the Greenleaf Foundation. Today, we have special guest Jason Ford here with us from Primerica. Jason will be giving us a money management overview today that preps us for our 3 upcoming financial literacy series sessions. So we always like to start with what exactly is Greenleaf Connect. Well, Greenleaf Connect is a weekly forum for us to be direct, informative, and provide transparency to our audiences about all things Greenleaf. Today's event is a Connect event, which means it's a more private group with videos on, live Q&A, while our live stream events are for larger groups and are open to the public. We also like to start with our rules of engagement for our time together. First, you can change your presentation view by moving the slider between the presentation and the video to make the presentation or the videos bigger or smaller. We do kindly ask that you mute yourself during the presentation portion of our meeting to avoid any feedback as we go through our presentation. And we will hold a live Q&A session at the end, so be thinking of your questions. And a friendly reminder that this session is being recorded and will be made available on Workplace by the end of the day tomorrow. So for our agenda today, Jason's going to start off with a money management overview where we'll learn a little more about how money works. Then we'll move on to asset management, where we'll touch on the rule of 72. Jason will also review debt solutions and the debt stacking model. And then we'll end our presentation portion today with protection management on how to protect your income. And finally, we'll close out with our live Q&A and some important upcoming dates. So without further ado, I want to introduce everyone to Jason Ford, who is a financial broker and coach with Ford & Associates in Primerica. Welcome, Jason.
All right. Thank you so much, Natalie, for that wonderful introduction. As we get ready to transition over. All right. So ladies and gentlemen, I definitely appreciate this opportunity to be before you all on this afternoon. Hopefully you have some, paper and pen to take some notes. I'm going to share you some information that's going to actually help you when it comes down to your finances. So let me share my screen here. All right, so I'll give you first give you a little background about myself. I'm actually originally from New York. I've been living here in the Atlanta area for well over 30 years now. My background is actually in computer information systems with a minor in business administration. But I got involved in this industry called finances 12 years ago. And the reason why I got involved in this industry is because my wife is a school teacher and she's been teaching for over 20 years now. And when I looked at her retirement plan, so in the school system, their retirement plan is a 403B, corporate America, we have those 401ks. And when I looked at her retirement plan, it was putting us in a position where we had to work to about 70 or 80 years old. And I knew that could not be a financial game plan for my family. We have 3 girls that are 16, and working to 70 or 80 was not the game plan. So at that time, I had a financial coach come sit down and teach us some basic principles about money that was never taught to me growing up. And once I saw what he was doing, I said, I got to do what you're doing because I know financial literacy is lacking in our community. And so he just said, well, Jason, you have to get a license. So that's exactly what I did. I decided to get licensed in the area of money. So I'm going to actually go over some of those 3 principles. Okay. And in order to create generational wealth, there are 3 principles to wealth that I coach people on. All right. And Natalie, I want to make sure I'm not breaking up. Am I?
You were for a little bit, but now you're okay.
Okay. I'm sorry. Okay. So there's basically 3 principles of wealth. And so if you follow these 3 principles, we're going to put you in a position of wealth. Number 1, you want to save as much money as you can, as fast as you can. So the first principle to wealth is save. The second principle to wealth, I call it good. And that stands for get out of debt as fast as you can. Because if you have $50,000 saved, but then you also have $50,000 worth of student loans, credit card loans, or car loans, you have no money. And then the third and final principle is you want to protect the wealth you have not yet created. So I'm going to lay the foundation over those three principles today. And then going forward, every Thursday, we're going to break down each principle every other Thursday. Well, every Thursday will be a different principle. Okay. So let's dive in. So how money works. Most people are concerned about money matters, but few truly understand how money works. So basically, your money, our money should be working for us when we're not working. And it also should be working for us when we are working. So the hardest thing that should be working should be our money. Okay. And one thing as a financial coach that I teach people on is you want to become an owner of your money, not a loaner. You want to become an owner of your money, not a loaner. What I mean by that, when we all get paid, I was always taught as I was getting paid, making money, to take my hard-earned money and put it into like your credit unions and your banks. And my parents always said, well, Jason, if you want to create wealth, put your money into a savings account, put your money into like a CD. And that is what I was doing, but I noticed my money was never growing. And I don't know if any of you all out there have savings account or CDs, and you probably noticed the same thing I end up noticing, that your money wasn't growing. And the reason why it wasn't growing, because what the financial institutions would do with our money is they'll take our money, your money, and invest it into the global economy. And so what is the global economy? The global economy is just anywhere where you and I spend our hard-earned money. So that could be at the grocery store, the gas station, Amazon.com, wherever you spend your money, that's the global economy. And so once I realized what the financial institutions was doing with our money, I said I have to do the same, and I must teach others how to do the same thing. Okay, so I'm going to be sharing with you all how you can take advantage of the global economy. So all financial institutions know of a concept called the Rule of 72. Now, some of you may have heard of this rule before, and if so, I hope you've been applying it ever since you heard of it. And if you never heard this rule before, after today, you want to make sure you start implementing it. So the Rule of 72, they call this rule the banker's rule, but I call it the money game rule. Meaning, if you don't know the rules that the financial institution play with your money, how can you win in the game of money? So now my oldest daughter, she's a chess player. And if she doesn't know the rules to chess, how would she know if she's a winner or loser in that chess match? So same with our money, we don't know the rules, we can't win. And this rule was made famous by Albert Einstein. And it basically means if you take the number 72 and you divide it by whatever interest rate you're earning on your money. So that could be your checking account, your savings account, your IRAs, your 401ks, wherever your money's at. If you take 72 divided by the interest rate, that will equal the number of years it will take for whatever dollar that's in that account to double. So for example, let's say an individual had $10,000, okay? And they went to invest their money and they had the option of a 3% rate of return, 6% rate of return, or what the financial institution is averaging, a 12% rate of return. So let's see what happens with that $10,000 over a period of time. So if you have $10,000 at a 3% interest rate, if you take 72 and just divide it by 3, not percent, but just divide by 3, that will give you 24. So what that means, it's going to take 24 years before that 10,000 doubles one time to 20,000. So every 24 years, that money will double. So in year 48, that 10,000 is now 40,000. And for those of you who may be taking notes, just know that 43% of Americans, when they retire with less than $40,000 saved. And why is that? It's because of the interest rate we're seeing on our money. Now, let's say someone was able to see a 6% interest rate. That same 10,000, 72 divided by 6 is now 12. So as you see, every 12 years, that money will double. So in that same 48-year period, that $10,000 at a 6% interest rate will double to $160,000. Okay, 4 times that amount at a 3% interest rate. But now let me show you what the global economy has been averaging over the past 50 to 60 years. Been averaging 12% or better. So now that same 10,000 at a 12% interest rate, 72 divided by 12 is 6. So every 6 years, that money will double. So over that same 48-year period, that $10,000 one-time investment, 48 years later will double to $2,560,000. But all we received at a 3% was $40,000, and at a 6%, $160,000. So the question I always get asked, or the question I usually ask, is who typically kept the almost $2 million difference? And it's the financial institutions. Now, I'm not here to beat up on the banks and the credit unions, okay? I'm not here to beat up on them because at the end of the day, we need those financial institutions, okay, to handle our checking accounts, to handle our savings accounts. But to create wealth, wealth will not be created by putting your money into those institutions. And so one thing that I do as a financial coach is I show you how to invest your money or where to put your money where you can average that 12% or better rate of return. Okay, so that's going to be one of the sessions I'm going to be doing next week, Thursday. I'm going to talk about more in details on how you see a 12%, where do you invest your money to see that type of rate of return. Okay, that is principle number one, save. And the goal is to save up enough money so that when you're ready to retire, you can live off the interest of your money. And a lot of individuals do not know what their, what I call your financial independence number is. And with a financial independence number, what that represents is the amount of money you need to have saved up. So when you do retire, okay, you do not have to go back to work unless that's something you want to do and not because you have to go do it. So I'll be able to sit down and coach you all individually on your financial independence number. All right. Now, the second principle to wealth, I call it good. Okay. And that stands for get out of debt as fast as you can. That's going to be the key. You got to get out of debt as fast as you can. So I coach people how to get out of debt within the next 3 to 5, no more than 9 years. And it does not consist of any loan consolidation or filing for bankruptcy. It's all about knowing who to pay, when to pay, and how much to pay, okay? Who to pay, when to pay, and how much to pay. So here we have an example of an individual that has 5 pieces of debt that they're looking to pay off. So retail card 1, credit card 2, car loan, credit card 1, and a mortgage. And you notice that their monthly total is $2,720. And so when it comes down to tackling their debt, what you want to do is you want to focus all your efforts on the smallest debt possible, the smallest debt, and you pay the minimum on everything else. So with the debt stacking principle, once this individual paid off retail card number 1, which is $220, typically what most individuals will say is, hey, I just freed up an extra $220, let me go spend it. No, that's not what you want to do. You want to take that $220 and you want to apply it to the credit card 2. So now credit card number 2 will not receive $353 a month, but they're now going to receive $573, and you pay the minimum on everything else. And you keep on doing that until your debt is paid off. And if you notice, the monthly total never changed. It was all about knowing who to pay, when to pay, and how much to pay. So when you're tackling your debt, the analogy I like to use is if you're going to chop down a tree. So we're going to chop down a tree. We're not going to take little nicks here at the bottom, little nicks at the middle, little nicks at the top of the tree. We're going to focus all our efforts. We're going to focus all our efforts in one area of that tree until it falls down. And that's the same thing you're going to do when it comes down to paying off your debt. You're going to focus all your efforts on one debt, chop it down, and go to the next. And so that will be another session that we're going to just focus strictly on getting out of debt. Okay, getting out of debt. And so without the debt stacking principle, this individual would have taken 23 years to pay off their debt. And they would have paid over $214,000 in interest. Okay, with the debt stacking principle, we was able to help them get out of debt in 9 years and avoid almost $130,000 in interest. And so now that the debt is paid off, we then told that individual, well, you were already comfortable in paying $2,720 a month. You now take that same $2,720 a month and you invest it. In this example, at a 9% interest rate. So now the individual will have over $2.4 million saved, and now you live off the interest of your money. That's the key. The key is to live off the interest of what your money is earning. And so that will be something that we'll discuss in more detail as I go over the debt stacking in one of our sessions. And then the third and final principle to wealth is you want to protect the wealth you have not yet created. And you want to protect the wealth you have not yet created. And so I'm going to explain that using this analogy on the screen here. So what if you had a toaster? So you went to Amazon.com and you ordered this toaster, okay? And with this toaster, on the 1st and the 15th of every month, $2,000 popped out. So that's $4,000 a month, okay? $4,000 a month. Would you like the toaster? I know I would. Would you put insurance on the toaster? Meaning, would you make sure that you put insurance on this toaster so every month $4,000 comes into your home? Absolutely. Well, of course, unfortunately, there is no such toaster, but just know you are the money machine for your family. And so when I say protect the wealth you have not yet created, that is making sure you have adequate life insurance in place. 9 out of 10 middle Americans have no life insurance in place outside of the job, because what we typically have on the job, we don't own it. Because the moment we leave a job or they let us go, or even if we retire, we're no longer part of the group. Therefore, we do not keep the group benefits. Okay. So my wife and I, we really got big in this industry because, to be transparent, we were the ones literally going to funeral, at the funeral, passing the hat around. And the hat will typically come down my road a whole lot more often, because they said, well, Jason, you graduated from college, you have all the money, you should help. And I said, no, that's not how it works. Yes, I graduated magna cum laude from Florida A&M University. But my job is not to take care of you when you pass away. We have to be more proactive than reactive. What I mean by that, we'll put insurance on our cars, our homes, our tablets. We'll even put insurance on the packages we send through the mail. But when it comes down to our life, most people do not do that. And I tell people, GoFundMe is not a life insurance plan. So one of the other sessions that we're going to talk about is protecting your income. That's all life insurance is protecting your income. And so let's say you were going to a financial institution. You have Bank A and Bank B. So which one would you prefer? Let's say you go to Bank A and they say, hey, sir, ma'am, when you put your money into our institution, we're going to keep all your money for the first 3 to 5 years. So before you can even touch your money, we're going to keep it for 3 to 5 years. Would you want to bank at that bank? They also stated that while your money is in our bank, we're going to give you about a 4% rate of return on your money. Well, we just learned earlier that 72 divided by 4 is 18. So that means 18 years was going to take for your money to double. Would you want to bank at the institution? Not only that, okay, they also stated while you are banking with us, and if by chance you actually need money, you can actually go borrow the money. But when you borrow the money, you have to pay us back at an 8% interest rate. So I'm not a mathematician, but let's say if you have a 4% interest rate, but you got to pay it back at 8, who is actually winning in that equation? They can hold your money for up to 6 months. And when that person passes away, the insurance company, that financial institution, they will keep the cash, but give your family the death benefit. But then we have Plan B. You all see Plan B on the phone on the screen here. Your money is credited to you immediately. You have a 10 to 12% potential rate of return on your money. There's no fee to withdraw your money. And if you need your money, you get that within 24 to 48 hours. And when the individual passes away, the family not only gets the death benefit, they also will get the cash. And so what am I talking about? There's basically 2 types of insurance. I'm not going to go into too detail. That's going to be a breakout session that we'll do on a Thursday. But there's 2 types.
That RFA I sent you.
1 minute. Let me try to mute this person. There we go. There's basically 2 types of insurance. One is called cash value or whole life. So cash value is designed where you have a high premium, low death benefit. So in this example, John and Mary has $150,000 each of life insurance. And I commended John and Mary because they beat the odds, meaning 9 out of 10 of us don't have it. They had it. But I said, John and Mary, I noticed you had no coverage on your children. Now, you do know that sometimes, unfortunately, the children could pass away before the parents. And they never thought about that. So they had $300,000 worth of coverage paying $295 a month. So what I recommended was term insurance. So term insurance allows you to get more coverage, pay less in premium. So now John and Mary has $400,000 each, $10,000 on the children for a total amount of coverage of $810,000. And they're only paying $126 a month. So I saved them $169. And what do you think I told them to do with the $169? I told them to invest it in the global economy. So they took the 169, invested in the global economy at an interest rate, just a modest interest rate of 9%. So they took the 169, 35 years later, they have $500,000 saved. So just know insurance is insurance, investments are investments. Never merge the 2 together. Those are 2 separate accounts. And life insurance is only needed if we pass away too soon. But if we live too long, that's where the investments come into play. So I don't want you to have life insurance your whole life. I want you to make sure you have investments your whole life. But until you complete principle number 1, which is save, and until you complete principle number 2, which is getting out of debt, you got to make sure that you're protecting your income that your family is depending on. And our vision of change, as I wrap up, and then I'm gonna pass this back on to Natalie. But our vision for change, I'm here because I want to save millions of families from financial ruins, the families that the large corporations do not care about. I want to help them protect their families, get out of debt, and learn how money works. So at the very least, I want to be in a position where I'm able to sit down and coach each and every one of you individually, one-on-one, on your personal financial game plan. It's absolutely complimentary. So there is no charge for me to sit down with you to make sure you and your family are in position of creating wealth. There will be a calendar invite that you all will have access to where you can schedule a one-on-one with me. If not myself, it'll be myself or one of my licensed agents that are part of my firm. Okay. And the calendar invite will be one way that you can reach me to schedule, or you can call or send me an email and we can definitely make sure we get you scheduled. So I definitely appreciate the opportunity. I definitely appreciate the opportunity to speaking with you all on this afternoon. And Natalie, I'm going to pass it back off to you.
Great. Thank you, Jason. It's such educational information, and we can all certainly use that to our advantage. We want to thank you all as well for joining us today. This does conclude the main portion of our presentation, but now we'll move into our Q&A session. So we did have a few pre-submitted questions that we received, and once we work through those, you can unmute yourself and ask Jason any other questions that you might have. Okay. So Jason, the first question that we have for you is, how do you find out your interest rate on your personal accounts, and how do you know if the rate is competitive?
Yes, so that's a great question. So when it comes down to your interest rate, whenever you look at your statement, so when you get a statement in the mail, it will actually state on your statement your current interest rate. And then that interest rate will actually show you how much you're earning. So I know when my wife and I were saving our money at the bank, our interest rate was like 0.008%. So we was wondering, when we received our statement at the end of the year, it stated, well, you earned, and some of you all may relate to this, you earned 30 cents in interest. I said, so a whole year of my money sitting there, I only earned 30 cents. And the reason why, because the interest rate was 0.008. So on your statement, it will actually show you your interest rates. So I wasn't even doing one. But if I was doing 1%, 72 divided by 1 would have taken that money 72 years to double. Now, to answer the question, is it competitive? The interest rate, when we're talking about investing, and I'll dive in that more details on our next session, when it comes down to investing, you're going to be investing your money in what we call mutual funds. And as a financial broker, I have access to over 10,000 mutual funds. And there's funds out there that have been averaging, as I mentioned earlier, 12% or better. And so I'll be able to sit down and coach you and show you how to make sure that your money is working for you and not against you. So looking at your statement will be the key place to determine your interest rate.
Great. Well, when trying to save money, a lot of us think that we can't have any fun. So how can you save money and, let's say, still go on a vacation?
Yeah, that's a great question. I believe that you should be able to save, get out of debt, and still enjoy life. So it's going to be all about priorities. So if you know that, hey, I want to go on a vacation, then we got to make sure that we are budgeting and preparing for that vacation. I'm not saying, oh no, don't travel, don't enjoy life. Definitely do that. But we want to make sure that we're doing it in the confines of our finances. So I could definitely sit down, put a budget in place, show you how much you need to put towards your savings, how much you need to put towards your debt, how much you need to put towards your daily living, how much you need to put away towards vacation and traveling. And we can definitely sit down and discuss in more detail how to make that happen.
Right. Well, that's definitely some good news that we can still have some fun and save for our futures.
Absolutely. Absolutely.
So Jason, you mentioned earlier the one-on-one coaching with you and your team. Can you let us know a little bit more about how this works and how we sign up?
Yes. So when it comes down to the one-on-one coaching, I'm open to meeting with you individually and or your family, spouse or significant other. We can make it a family type event as far as the financial education for the family. And it's just a matter of getting on my calendar. We'll make sure that each and every one of you will have the calendar link so that you can see my availability and you can book a one-on-one appointment with myself or one of my managers, management team. And also you can reach out to me via my email address or my cell phone number, which is 678-362-1160. And typically these sessions, depending on the individual, can last anywhere between 30 minutes to an hour. So if you're looking to carve out some time throughout the day or evening, 30 minutes to about an hour is typically how long the coaching sessions will last. And it won't be just a one-time sit down. So if you want ongoing coaching, my firm and my managers will be your ongoing financial coach until we help get you to financial independence.
Awesome. And for the coaching, do you offer bilingual services?
Yes, that's a great question. So I'm working with a couple of individuals that could help me when it comes down to the translation. But we are working real soon here where I'll be able to assist individual when it comes down to bilingual to help them as well be in position of financial independence. So if you give me maybe a couple of days, I'll have something in place where we can definitely help those individuals.
Wonderful. I know that will definitely be beneficial to our workforce. So
Absolutely.
those are all the pre-submitted questions we have. So let's open it up to the group and see what other questions we have for you, Jason. So you guys are more than welcome to turn your videos on and unmute yourself. There's also the chat feature at the bottom of your screen where you can submit questions. So we'll just go round robin for anybody who has one. If you have the question, more than likely somebody else does too.
I'll ask a question.
Okay, go ahead.
So thank you for taking the time to do this. I'm really excited just in our workforce portion. But I did financial counseling maybe it was about 2 years ago. And it was definitely something I enjoyed just for accountability. And I think that's my biggest question was when we do coaching, you said that you can set up multiple times of coaching. And I guess in terms of the thing that I really enjoyed that I got out of using was that she utilized like spreadsheets and things like that. And so do you offer those within your counseling so that we're able to manage ourselves, but then also so that you're able to see kind of what it is that we're doing? Because it really broke up my spending and it really held me accountable, which is a big thing.
Yes, absolutely. So when it comes down to the budgeting and getting out of the debt portion, yeah, we have spreadsheets that we can put together where you can input your information. And then from there, we can definitely coach you on how to tackle the budgeting, how to tackle the debt. So yes, there are spreadsheets that we can share with each other. And as I make updates and changes and recommendations, you'll be able to see that as well.
Okay, great.
Yeah, you're welcome.
I have a question. For someone with modest discretionary income for investing, what platform do you recommend that person use in your recommendation?
That's a great question. So when it comes down to investing, the minimum that it takes to invest, where you can take advantage of the global economy, is $25 a month. So someone can invest with me with as little as $25 a month. It doesn't matter how young or how old you are. My youngest investor is my 6-year-old daughter. She started investing with me when she was 4. And my oldest investor is my 96-year-old grandmother. She started investing with me when she was 93. So there is like investment to the saving, investing. $25 is the minimum that it takes to start investing. And as a broker, I use several platforms, several companies when it comes down to their mutual funds. So you have companies like your Fidelity, your Voya, Franklin Templeton, American Funds, Invesco. So depending on the client's need will determine which financial firm I'm going to use for the investments.
And Jason, what you'll do in our asset management session, which is next Thursday, you'll kind of go over in more detail kind of what those platforms are. And then in the one-on-one coaching, if people sign up, that's Jaron, where you can get more detailed information of what's going to work for best for you personally.
Absolutely. That is correct, Natalie.
I'm sorry, I have one more question because that did raise something that Jaron, when you started to talk about your daughter, do you do any information in regards to, because I have a 5-year-old, and so when you're starting to think about education and things like that, when I started to look at the programs, I became extremely overwhelmed. So is that something that you offer in your counseling as well, like in terms of investing in the education?
Yes, there's different investment vehicles that we can use for education. And even if the individual, the minor decide not to go off to school, there's also investment accounts for them as well. And yes, next week, you definitely don't want to miss that session. We're going to definitely talk about the different accounts that you want to have open for minors.
Yeah. Thank you.
You're welcome.
They
I
continue to take your
actually,
money.
I'm sorry.
Go ahead.
I had a question about investment as well, only in the well, in the sense that you said you have your daughter investing and stuff like that. So I guess my question would be when you have someone invest with you, do you manage it? Do you give us advice on how to manage it? Like how does that work on that end of
Yeah.
things?
Yeah. So I will be your broker over the account. And what it is I'll make recommendations based off of your risk factor, your tolerance, how you feel about the market and things of that nature to determine my recommendations. And then the mutual fund portfolio managers, depending on which platform I use, they are actually the ones that will sit there, watch the money 24 hours a day, 7 days a week to make sure it's doing what it needs to do. I will basically be your go-to contact as far as reviewing your client, reviewing your portfolio and making sure it's doing what we're expecting it to do.
Awesome. Kind of a side note to that as well. Like I have a Roth IRA with Vanguard. Would you be able to help me with that as well? Like with that kind of thing?
Absolutely.
Okay.
Yes,
I just didn't
yes,
know
I
because
can.
I have no idea how that stuff works. I was like, okay, cool. This is awesome. Great opportunity. All right. Thank you.
Yep, I sure can. And that's one of the things I'm going to talk about on our next session next week, Thursday. I just give you a little teaser. So we're going to talk about a Roth IRA. There's going to be accounts you probably never heard of called a TOD. And Krista, you was asking for a minor investment for college, but I'm going to introduce you all to an account that's called UGMA, UGMA. But I'm not going to dive into too much detail. You got to be on next week.
So
Sounds good to
Jason, to underline what George was saying, so when we meet with you for one-on-one coaching, you're going to take a look at all of our current portfolio and investments and give us recommendations on those, and then also new outlets that we could go into.
That is absolutely correct.
Wonderful.
Excellent.
Dominique, you have a question for us?
I was going to say, I don't have a particular question at the moment, but thank you so much for coming. I just wanted to express that I have student debt that I would love to tackle. So really just wanted to express my gratitude for coming on and sharing all these insights with us.
You're welcome. And then, yeah, definitely, I can definitely show you how to tackle that student loan debt.
Okay, any other questions out there for us?
Oh, when should we see that?
All great question. Oh, go ahead, George.
Oh, okay. Sorry. When will we be able to see that calendar invite? Because I'm sorry, I might have missed it, but I want to make something as soon as possible.
Yeah, when I post the recording on Workplace tomorrow, that link to Jason's calendar will be there, so you guys can sign up. And then every week we'll repost that. So if you don't sign up this week, you can sign up anytime afterwards.
Awesome. And you said I'm sorry, keep going.
I'm sorry. What I'll do real quick, I actually will put it in the chat as well. My calendar. There we go. Go ahead. What's the other question, George?
Oh, and I was just going to say also, and you said, I might have heard this wrong, but you said as many sessions as we need for this kind of thing?
Absolutely.
Oh, lovely.
You heard it correct.
Awesome. Okay, cool. All right. Just want to make sure.
Like I said, it'd be me personally or one of my managers that are also licensed to do what I do. Between me or them, we'll be in position to make sure we coach you on your financial future.
Thanks so much.
And just cost, like I said, a reminder, it's complimentary. So I do not charge to sit down and coach you on your financial game plan. So just want to let you all know that as well. Go ahead, Natalie.
Wonderful. Well, we will go ahead and close out with our important upcoming dates that we have here on the screen. So like I said, tomorrow, this recording will be made available along with Jason's link to his calendar. So we definitely encourage you to sign up for that introduction coaching session and then seeing what other sessions you can schedule with Jason. Then on Monday, January 17th, a reminder that Greenleaf is closed in observation of Martin Luther King Day. And then on Friday, January 21st, Stephanie is going to be hosting our vision board session. So definitely join us for that. She'll be giving more information to us. She'll post that on Workplace and send out an email so we know exactly what to do for that. And then on Monday, January 24th, we have our monthly social hour with the commercial team, which again will be all virtual, but we're in store for some fun. Then our Greenleaf Connect schedule. So today we held our first financial literacy series session on the main money management topics. And next week we'll meet with Jason again, where he'll review asset management. And that's a savings plan that makes sense. Then also that day at 3 o'clock, we have a tentatively scheduled our Oak Hollow sale update. So join us for that. Then on the 25th, we have at 11 and 2 p.m. our fourth quarter live Q&A session, which is with our investors. So you guys are all welcome to join us for that as well. Then on the 27th, we have our third session for our financial literacy series on debt solutions. And that strategy is to get out of debt. So all of those with student debt out there, definitely let's join that one. And then we're going to close out on February 3rd with our fourth financial literacy series session on protection management, and that's protecting your income. So last but not least, a reminder on our new professional development partnership with a company called Kudo. You will receive an email tomorrow with more details on the program itself. And then next Friday, which is the 21st, you'll receive your login to the system along with the user guide to navigate the platform. And I'll, of course, be available for any questions that you have on that program. But as a reminder, the program is free of charge to you. You'll get your own personal online account with access to over 800 online courses to choose from. And like we discussed last week, this is anything from language classes to communication skills and software programs. So lots of good stuff on there. And best of all, there is going to be a Greenleaf completion incentive program for the courses that you do complete. And we'll have more information for you on that by the end of the month. So thank you all again for participating in today's session, and we look forward to seeing everyone next week for our second session of our financial literacy series, where again, Jason will dive into more details on asset management. So thank you again, everyone, and enjoy your day.